Learning how to trade options can greatly improve your trading success. There's two main reasons to consider adding options to your trading strategies. The first is the amount of leverage that you get from trading options can greatly increase your profits. This is especially important for high dollar stocks. You can get access to a fairly large number of shares, or the equivalent of a large number of shares, for relatively few dollars. The second reason to consider options is as a way to hedge, or basically as a way to get insurance on your existing positions in case a stock does move against you. You can also use that same strategy to generate income, basically a way to generate your own dividend on a stock while you're holding a stock in a sideways market. So in this video, I'm going to show you some really basic option strategies. But just because they're basic doesn't mean they're not effective. Quite the opposite. I use these regularly, and they're low risk, high potential reward strategies that you can use just by learning some basic option techniques. For most people, when they begin trading options, or when they think about trading options, the first thing they do is they start buying out of the money calls. And you'll see as we go through this video why that's really not an effective way to trade options, and why there's much better strategies out there that can not only lower your risk, but also greatly improve your probability of success. If your main strategy is just buying out of the money calls, you might have a few of those really big winners, where a stock just shoots up and you're making 200-300% on your option, but you're going to lose a lot more money in all the options that expire worthless that your winning trades won't even make up for all the losses you're going to take. So in this video, I'm going to show you 3 strategies that I use regularly that have really greatly helped improve my account balance. All right, so let's get into it. So the first strategy I'm going to go over is covered calls. So the way this one works is you own a stock and you sell out of the money calls against it. Now, the reason you would do this, well, 2 reasons you would do this. One is it does give you a little bit of a hedge if the stock starts to move down against you. So it gives you a little bit of insurance or protection that way. The other reason you would want to do this is in a sideways trending market or in a sideways trending stock, you're basically generating income. So you're almost like creating a dividend for yourself out of the stock by selling weekly out of the money calls. Now, the downside to this strategy, really the only downside to it, is that it does limit your potential profit. So let's say, for example, you own a stock and you sold a covered call against it, and some news event comes out or some event comes out and the stock just skyrockets. It shoots up 20% in one day. Well, the problem with having covered calls is now you've limited your maximum profit to whatever strike price you sold that call at. So you're not gonna see that full benefit of that move in the stock price. Now, that being said, covered calls are a great way to generate income in sideways markets and slow-moving stocks. The only time you wouldn't want to use a covered call strategy is in high volatility markets, or if stocks are really trending up high right after a breakout. If you're expecting big moves in a stock, you wouldn't want to use this covered call strategy, again, because you're limiting your upside potential. People often say, my goal is I want to beat the S&P 500. Well, I'll tell you what, it's really easy to beat the S&P 500. All you need to do is buy the SPY or buy the SSO and then sell weekly covered calls against it. And you've beaten the SPY. So I'm going to run through an example here of how to set up a covered call. For this, let's look at General Motors, so ticker GM. This is actually a pretty good stock to look at. It meets most of my criteria of when to use covered calls. So we'll run through this one as an example. In this example, let's assume that you bought GM stock at $40 a share. So looking at the option table, in this case, what I would do is sell the weekly $42 call for 63 cents. This effectively lowers your cost basis in the stock from $40 down to $39.37. So now you might ask, well, why $42? Why'd you pick that call to sell? Well, there's a couple reasons. First, let's look at the chart. Whenever you're trading options, you still want to do the technical analysis on the chart, just as if you were trading the stock. So what you want to do is you want to look for support and resistance levels. When you look at this chart, you can see that $42 is a previous resistance level, and the stock's having trouble getting above that level. So selling the $42 call is very reasonable in this case because you wouldn't expect the stock to trade above $42, at least not for the next, short term, not within the next week or two. The other reason for selecting $42 is if we go back to the option table, you can see that the delta on the $42 call is 0.33. Now, the delta tells you two things. First, it gives you the correlation between that particular option and the stock price. So a delta of 0.33 means that for every $1 movement in the stock price, the option price is going to move by 33 cents. The second thing that the delta tells you is it gives you a rough probability of that option being in the money at time of expiry. So now remember, we're selling calls against the position that we have. So we don't necessarily want the option to be in the money at the time of expiry. We want to collect that premium, right? So a delta of 0.33 means that there's only a 33% probability that that option will be in the money on the expiry date. So whenever you're selling calls against one of your positions, you typically want to target a delta of anywhere from 0.25 to 0.35. So you're saying there's only a 25 to 35% chance that the stock is going to close above your strike price at the time of expiry. So if you were to do this trade, buy the stock at $40, sell the weekly $42 call, there's two ways this can play out. Scenario one is the stock moves up, it breaks out of its current sideways consolidation, and it trades above $42 at time of expiry. So what happens in that case? Well, on expiry, you would get the stock called away from you at $42. So your profit would be $42 minus the $40 that you paid for the stock, plus you get to keep the 63-cent premium that you collected for selling the option. So you have a total profit of $2.63, or 6.6%. Now, if the stock continues moving higher, you're going to say, well, that wasn't a good idea to sell the call because now you're missing out on all this additional profit if the stock, say, moves up to $45. And that's true, but you got to remember, this was a very short-term trade. So if you're making 6.6% in 1 week on one trade, that's really not that bad. I'll take that any day and then look for another trade to set up either in the same stock or in a different stock. The second scenario that can play out is if the stock continues to trade sideways like it has been doing and closes below $42 at expiry. So in that case, the call expires worthless. So basically, you just get to keep the 63-cent premium that you collected, and guess what? You can do it all over again. So now you would sell another out-of-the-money call, likely again at $42, because that would still be resistance, but you'd have to check to see what the delta is. You would sell another out-of-the-money call. You'd probably collect again somewhere around 60 cents for it. And by doing this repeatedly, say over the next 2, 3, or even 4 weeks, if you're collecting 60 cents each time, you've now lowered your cost basis in the stock that you bought quite significantly. So now it's a lot easier to hold that stock and wait for the breakout. And then once it finally does break out about 42, again, it'll depend if you currently have a short call at the time or not. But at that point, you can even buy more shares because now you're buying a breakout, or just take your profit that you had on this covered call strategy and call it a win. So that's how covered calls work. Again, they're really good for generating income, really good for hedging your position. The only downside is you're limiting your profit potential, but it's a great trade for a short-term time frame if you're looking like 1 to 2 weeks out. All right, so that was for sideways trending stocks. Now, what about for stocks that are in a nice trend? And for the purposes of this video, I'm just going to assume stocks that are in an uptrend. Everything I'm going to show you here, you can basically do the exact opposite of it for stocks that are trending down. So in other words, if you want to short a stock or if you're betting on a stock moving down. But just to keep it simple, for the purposes of this video, I'm going to assume that we're looking at stocks that are in an uptrend or stocks that we are anticipating are going to continue moving up. So there's two other strategies I'm going to go over, and they're very related. One is called a bull call spread, and the other is called a bull put spread. So again, both of these are bullish positions. Both of these assume that the stock is going to at least stay at its current level or ideally move up. So I'm going to go over these in a lot more detail, but just to start off at a really high level, a bull call spread is basically you're buying an at-the-money call and you're selling an out-of-the-money call against it to lower your initial cost of the trade. A bull put spread, on the other hand, is a credit spread. You're actually going to collect premium on this, similar to how you did on the covered call, but you're going to do it with puts instead of calls. So you are going to sell an at the money put, and then you're going to buy an out of the money put as protection in case the stock does move against you. Just a couple differences between those two techniques. A bull call spread has a slightly lower probability of success than a bull put spread, but it has a much higher potential profit. On the flip side, a bull put spread has a much higher probability of success, but you are limited to what your profit potential is on that trade. So you might ask, well, how do I decide which one do I do? Do I buy a bull call spread or do I sell a bull put spread? Well, the first thing you want to look at is the implied volatility of the stock. During the time frame of your trade, are you expecting the implied volatility to increase or decrease? This is probably the biggest factor that goes into deciding which strategy you want to use. So maybe I'll just step back for a second. When you look at the price of an option, there's two things that go into the determining what that option is going to cost. The first is the time to expiry. The farther out in time that you are buying or selling an option, the more time value that option is going to have. And as you get closer and closer to the expiry date, the time value portion of the price starts to decay pretty quickly. The second component that goes into the price of an option is the implied volatility. So when a stock has really high implied volatility, the option prices are going to be more expensive. And when a stock has low implied volatility, the option price tends to drop. So that's really important to understand that differentiation. Again, high implied volatility is high cost for options. Low implied volatility, low cost for options. So if you're expecting the implied volatility to either increase or decrease during your trade, that's going to determine if you want to buy a debit spread or sell a credit spread. So to help you try and determine is the IV going to increase or decrease during your trade, just a couple examples here. So squeeze breakouts. If a stock is in a squeeze and then breaks out, that typically results in an increase in the implied volatility. Conversely, if a stock is in an uptrend but not squeezing and then pulls back to its moving averages, so say maybe it pulls back down to the 21 or the 50-day moving average and then bounces from there, typically that bounce will happen on a decrease in implied volatility. And then two other things that typically decrease implied volatility is post-earnings. So typically the volatility will increase up to the earnings date, and then after the earnings report, there'll be a what's called a volatility crush, or the volatility will drop. And the other one is after a news spike. So sometimes there'll be a news event and you'll get a big spike in the stock price, and then after that event, the implied volatility will decrease again. So the way you want to look at this is if you're expecting your implied volatility to increase, then you want to buy bull call spreads. Again, the reason for that is if you think the IV is going to increase, the option price is also going to increase. So if you're buying a debit spread, that option value is going to increase over the next days or weeks as the volatility increases. Conversely, if you're expecting the implied volatility to decrease, then you want to sell a credit put spread. And again, the reason you want to sell a spread in this case is because as the implied volatility decrease, that option value is also going to decrease and you can buy it back at a lower price for a nice profit. All right, so let's run through a few examples. Hopefully this will make a lot more sense when I show you this. So let's go through a bull call spread first. So some general rules on the bull call spread. You want to buy a call that's roughly at about 50 or 60 delta. So 0.5 to 0.6 delta. Usually that'll be at or very near the money call. Then what you want to do is you want to sell a call against your long call. And the one you sell, you want to target about 20 to 30 delta. So 0.2 to 0.3 delta. Now, when you do this, you want to try and keep your net delta above 30 if possible. So above 0.3. And when you're trying to select your expiry date, you typically want to buy 30 to 45 days out. Now, we're not planning on holding these that long. Typically, these trades are, 2, maybe 3 weeks max, and hopefully by then you're in profit and you get out. You very rarely want to hold an option to expiry. But the reason for picking a date 30 to 45 days out when you're buying a debit spread is that once you start getting within 30 days, that time value starts to have a pretty big impact on the option price. So outside of 30 days, you still get some time decay each day, but as you're getting closer and closer to the expiry date, the time decay or the loss in value of that option each day can be quite significant. You don't want that to affect your option price. Basically, you want to buy far enough in advance that the time isn't having an impact, but the stock price moving up is what's creating your profit. So for this example, let's look at GM again. So let's say in this case, if we believe that the stock is about to break out, okay, so if we think the stock's going to break out soon instead of trading sideways, so we want to use a bull call spread instead of a covered call strategy. So in this case, if we look at the option prices, what I would do here is I would buy the $40 call at $2.55. And you can see this has a delta of 0.56. So it's right in between that 0.5 to 0.6 range that we target. Then what you would do is you would sell the $45 call, which is a further out of the money call, and you would sell that at 66 cents. And you can see the delta on that one is 0.23. So that gives you a total cost for this trade of $1.89 and a net delta of 0.33. So that fits perfect within our general rules. Now, the way to figure out what your maximum profit on this trade would be is you have a $5 wide spread that you just bought, right? $40 to $45. So your maximum profit would occur if the stock closes above $45, either before or at time of expiry. And again, remember I said, ideally you don't want to hold this till expiry. So what you're looking for is the stock price to move up fairly quickly over the next week or two above $45. If it does that, your maximum profit would be $5, which is the width of the spread, minus the $1.89 that it cost you to enter the trade. So a total profit of $3.11. So now that's not bad. That's 165% profit. And hopefully you're realizing that within, let's say within a couple weeks. Now, on the flip side of that, let's look at another strategy that you can use on this exact same stock. It's still a bullish trade, but now this time we are going to sell a credit spread. We're going to basically sell a bull put spread instead of buying options. So to do this, we look at the put side of the chart, and we would sell a $40 put at $1.85. Now you can see the delta on that is 0.44. At the same time, we would buy a $35 put for 53 cents. And the delta on that is only 0.15. So this trade is going to net you a credit. You're basically going to receive $1.32 per share. And you can see that the net delta on this trade is 0.29. So just a few things you need to understand with this trade. The credit that you received of $1.32, that is your maximum possible profit. Okay, that's the credit you received for making this trade. You're going to either need to buy this back at a cost hopefully less than $1.32, or allow this to expire worthless, which typically you won't do, and I'll explain why you wouldn't do that here shortly. So your maximum profit is $1.32. Now what about your maximum risk? In this case, your maximum risk is the $5 wide spread, so $5 minus the $1.32 in premium that you collected for a risk of $3.68. So you can see that this one is basically the reverse of the bull call spread. Here your maximum profit is $1.32 and your maximum risk is $3.68. In the bull call spread, your maximum profit was $3.11 with a risk of only $1.89. So again, this goes back to the bull put spread has a much higher probability of success. The reason for that is you don't really need the stock to go up. If the stock trades sideways, you still make money. Whereas the bull call spread, the stock has to move up in order for you to be profitable. So on the bull put spread, just some general rules again that you want to follow when you're getting into this type of trade. You want to try and collect 1/3 the width in premium. And the only reason for this is you want to manage your risk reward, right? If you're collecting much less than 1/3, you're taking on quite a bit of risk. So in this example, we didn't quite get 1/3 because 1/3 of $5 would be $1.66, and we only collected $1.32. So while I wouldn't say it's a hard and fast rule that it has to be 1/3, that should be your target, what you try and collect. If you're a little below that, it's fine. The trade can still work out, but I always try and get 1/3 if I can. In this case, when you're trying to select an expiry date, Again, you want to go out a little more in time, but for this one, I typically just try and target 30 days. And again, remember the reason is that once you get within that 30-day time frame, and especially once you get within 2 weeks, the time decay starts to drop the option price quite rapidly. So, and again, in this case, we want the option price to drop because we sold the credit. Once we get into that within that 30-day window, we can see our profits start to go up pretty quickly. And the final thing I would say on bull put spreads is when you're trying to decide which put to sell short. So like in this case, we sold the $40 put. You want to always make sure you're at least less than 0.5 delta. And there again, you want to make sure that there's a less than 50% chance that the put you're selling is going to end up being in the money at expiry. So always sell less than a 0.5 delta. In this case, we were at 0.44, so that was good. All right, so hopefully with those examples, you now have a better understanding of what the difference is between a bull call spread and a bull put spread and when to use each one. Now, I just wanted to go over a few more things to consider when you're putting on any one of these three strategies. So whenever you're trading options, and it could be any strategy, not even just these three. Whenever you're trading options, you always want to pick a stock that has really good option liquidity. Now, what's the reason for that? Well, it's especially important if you're buying options. So if you're buying a bull call spread and let's say the stock moves up, well, to make the profit, you have to be able to sell that call. And if the liquidity is really low in a particular stock's option, you're going to have a hard time selling that call. So even though the stock went up, you might not realize that full potential profit that you should have had if the liquidity was better. Now, the other thing to note is that you always need to have a directional assumption. So trading options is no different than trading stocks. You have to have an assumption on, do you think the stock is going to move down, sideways, or up? You have to know that, based on the technical analysis of the chart prior to getting into the trade. Similarly, your entry and exit levels. So just like if you're trading the stock, you need to have the right entry. You need to know where the support and resistance levels are. You need to have a plan and a strategy before you even get into the trade on where you want to get in and where you want to get out. Now, as far as getting out of losing trades, what I do for options, instead of setting a hard stop like I do on my stock trades, I set an alert based on a stock price. So in other words, I don't use the price of the option to set my stop, which you could do in most trading platforms. But what I prefer to do is I like to look at the stock chart and use the technical analysis of the chart to define my, this is where I'm wrong level. And I'll put an alert there. And if a stock breaks below that level, then I'll go in and manually sell my options or close out my options, either buy or sell. Now, the other thing you want to look for when you're trying to decide which stock to trade options in is you want the bid and the ask spread to be very small. You saw in these examples for GM, the bid and the ask were, roughly 5-10 cents apart. And if you can trade that option somewhere in the middle of that, that midpoint between the bid and the ask, that's usually, where you want to target. But some stocks you'll notice have really wide bid ask spreads. It could be even up to $1. And it's really difficult to trade those types of options because again, remember, if you buy it, you're going to have to sell it at some point. And when the spread is that big, even if the stock moves up, you might not get the full potential profit that you should have got just because the spread is too big on the bid and the ask. To help find stocks that have a good bid-ask spread and also good option liquidity, basically what you want to look for is you want to pick highly traded stocks. So you want to find stocks that trade at least 1 million shares or more per day. Those typically also have good option liquidity. So people often ask, how do I know when to get out of these trades? Let's say I get into one of these option strategies and I'm profitable. When do I get out? Because remember, with these strategies, you're often going to see 50 or even 100% gains. So how do you decide, when is a good time to get out and book the profit? What I do, your general rule of thumb, on credit spreads. So for example, if I'm selling a bull put spread, I will start taking profits or even just close out the entire position once I'm at 50% profit or greater. Now, you got to remember, when you're selling credit spreads, your maximum profit is that premium that you received. So once you start getting up above 50%, let's say you're at 60 or even 65%, the amount of premium left that you can still gain is pretty small compared to what you have the ability to lose. Because not only can you lose, all your profits, but you can actually let that turn into a loss. So especially in a credit spread, once you're up like 50 or 60%, your risk is really high compared to the little reward that you have left. So the way I would trade these, if I have multiple options, I would sell at least half when I'm up 50%. And then I would put my stop at break even on the remaining 50%. And if I did hit, say 60, 65%, definitely by 70, I would just close it out and I would be out of that trade. Now on debit spreads, 50% is also a good rule of thumb on where to start, but debit spreads do have quite a bit more potential. It's not unrealistic to get, 100% or even more than 100% gain on a debit spread. So typically what I would do for debit spreads, I would take some partial profits once I'm up 50%. And then depending on what the chart looks like, depending on the technical analysis of the chart, that would be my deciding factor if I'm still going to hold a partial position or if I would just close the entire thing out. So, you'd be looking at things like resistance levels. Is the stock making a new high? Look at the Fibonacci extensions. Is the stock way extended over the Bollinger Bands? Those are the kind of things you would have to consider on when to close out your debit spread. Okay, so the last thing I want to go over in this video is what are some good chart setups where you would actually use these strategies that we went over today? Again, we talked about some of the criteria on when to do a credit spread versus a debit spread, but what does that look like in the chart, for example? So the first one I'll go over is my favorite one to trade, my favorite pattern to trade. Doesn't matter if it's a stock or an option strategy. I love trading squeezes. So if you see a stock that's been in a really strong uptrend and is now starting to squeeze, the best strategy for that one is either to buy long calls, or a much better strategy, the one we looked at today, is to buy a bull call spread. Now, the way you would want to do this is, and this part's really critical. The way you would want to enter this trade is when you see the squeeze, you want to buy the bull call spread when the stock is as close to the moving averages as possible. And that could be the 21 or the 50-day moving average, depending on the chart setup. But you want to buy it prior to the stock breaking out of the squeeze. Because remember, we talked about when the stock breaks out of a squeeze, that increases the implied volatility. So if you wait until the breakout, you're now paying a lot more for that option. What you want to do on these is you want to buy them prior to the breakout in anticipation of the breakout. And then once they do break out, not only are you making a profit on the move in the stock price, but your options are also increasing in value due to the increase in implied volatility. So those are the ones where if you time these just right and you get a really nice big breakout, these are the ones where you can easily make over 100% profit in a very short time. Now, the other chart pattern I look at for option trades is a stock that's in a really nice uptrend, but it's not squeezing. Instead, it's pulling back to the moving averages. So if you have a stock, it's trending up and then it pulls back either to the 8 or the 21 EMA, or sometimes even all the way to the 50-day moving average, as long as it's still within the trend, as long as the uptrend hasn't been broken, what you would do is you would look for prior support. You would look for some type of confirmation that the stock is actually going to bounce from this level. And then from here, you could either do the debit or the credit spread. For this chart pattern, I would say both work pretty equally well. You could either sell a bull put spread at the support level, or you could buy a bull call spread. For the bull call spread, you'd probably want to wait and see a little more confirmation, maybe at least one green day, one green candle, maybe taking out the prior day's high, just to confirm that the stock is actually going to move higher up. For the bull put spread, that one I'd be more inclined to get in a little earlier, right as the stock is at support. Again, because for that one, the price doesn't have to move up for it to be a profitable trade. Even if it trades sideways, you're still making money. So I'd probably be a little quicker getting in that one. Whereas the bull call spread, I'd want to see a little more confirmation that it is actually going to bounce off of those moving averages. And the third pattern, we kind of talked about this one already, but it's the sideways consolidation. This one is basically just it's an implied volatility trade, is what it is. If you see a stock that you think is trading sideways and isn't really going to go anywhere up or down in the next few weeks, this is the perfect opportunity to sell out of the money options. So you can do what we talked about in this video. You can sell the bull put spread. Now, another strategy, I didn't really cover it here. It's a little more advanced, but you can look it up. It's called an iron condor. And basically what you'd be doing is you would sell the bull put spread, and then you would also sell a bear call spread, which a bear call spread is just the exact opposite of a bull put spread. And basically what you're doing is you're sandwiching the stock price in between these two option trades. And as long as the stock price doesn't go up above your bear call spread or down below your bull put spread, you're going to make money on both of those. And so it's basically a way of generating income in a sideways market where you think the stock's not going to go anywhere but trade sideways for a while. You sell these out of the money options, and you're basically just waiting for the time decay for the options to expire worthless, and you keep the premium. So it's a pretty easy trade in a low volatility market. So that's all I have for this video. Hopefully that helps. Hopefully that gives you a better understanding of options and how to trade some of these really basic option strategies. And again, they're really basic, really simple to apply, but they have very low risk and very high probability of success. Way better than just buying an out of the money call. So hopefully this video will really help out your trading. If you have any questions on the topics we covered today, you can post those down in the comments section and we'll be sure to reply to those. Or if you have any other topics you want us to cover in future videos, you can post those in the comments as well. And if you're enjoying the content, please hit the like and subscribe buttons, and we'll see you next time.